Looking at the non-operating expenses, right now this is just capital reserves. So this is what you're holding in reserves each year for that life of the property. Next section is your debt model. And you can see very straightforward. In this case, we only have an acquisition loan. You can see there's no principal payment, so it's interest only for 5 years, total debt service. And then you have your DSCR calculations, loan to value, and debt yield calculations. If you do model refinance, you'll see that come in here and that your acquisition loan will terminate and the refinance loan picks up on the following year. I also wanted to be very transparent about all the cash flows of the property. Sometimes this gets buried in other models. And so I wanted to really make it clear that these are the cash flow from operations in the first top section. Should use my So cash flow from operations right there. So entirely from operations, we're backing out the asset management fee, and then you can see your cash available for distribution for each of the years. So we definitely don't want to see that negative. It will flag the warning up in the KPI section if this goes negative. Capital events. So this is including all the refinancing, the sale proceeds, costs, loan payoff. You can see I have the return of reserves at sale included in here, so that gets included for proceeds available for distribution. And then if you have a refinance fee modeled or a disposition fee modeled, you're going to see that in this last section here. So I have 0% for both of those. And then these are the changes to the capital account. So when we have a refinance, you're going to see that there's a return of capital that happens, and then a certain percentage of capital returned. And that's much it. But it's just one place to go to see all the cash flows of the property, either from operations or capital events. Next to the return section, you'll notice that my return section has a lot of information in it. I tend to like to see everything that happens. I don't like to group different transactions into one line. So you'll see that here quite a bit. So the top section, this is really just the project level returns. And in that first section, you're going to see that cash flow from operations. This is just the cash flow that gets generated from the operations of the asset. This does not include any capital events. If we refinance or sale, it's not included in this number. And then if we have any excess cash flow, you're going to see it in the bottom line here, and you'll get to see the total annual cash flow. Below that, we have two return metrics. I have the average cash on cash. This is the straight cash on cash as a result of the performance of the property. And then I also want to show the preferred return. So in this scenario, we're running a preferred return deficiency that you can see right here. We have a deficiency throughout the entire life of this project. Um, we'll make that up on a capital event. We're going to make that up on sale. And so that is going to boost our cash on cash return so that our preferred return is equal to, or cash on cash return is equal to preferred return. For that reason, I've separated out the cash on cash return strictly from operations. So you can see how the asset is performing itself. We have the net proceeds from refinance or sale, very similar to the cash flow section above. And you can see in this section, we are paying or preferred return deficiency before anything else. And then any sale proceeds are split after the deficiency is paid. And then at that section is where I can calculate the average annual return is calculated at this part of the model. And then we have our total distributions. This includes all the inflows and outflows of the asset. So you can see our initial contribution, all the cash outflows, as well as our return of capital there. And then this is where our internal rate of return and our equity multiple are calculated. So you can see at each level and which return metric gets used to calculate the performance of the property at each level. Just below that is the exact same section, but just modeled for the LP. And the main difference there is that for excess cash flow from operations, I'm using the split that we set above in our return structure. And then the net proceeds, I'm using the split as well. And then everything else is exactly the same as the project. And then just below that, we have our general partner earnings. So I really wanted to call out all the places that a GP could make money, right? So we have our excess cash flow, refinance, sale. You can see it here, it has everything. So you know exactly where the cash flow that or the earnings for a GP are going to come from and when they will hit. So year zero being our acquisition fee, and you can see all the years after that. In the GP split worksheet, it's pretty detailed. You've probably seen this format quite a bit. I've seen it used multiple times. You have different air buckets of work that need to happen, and then you'll split that work among the partners, and then it generates what the GP split is. So the percentage of deal. So in this case, we're splitting the deal 50-50 with the LP partners and the percentage of GP of that deal. The one thing I did is I went ahead and I added all the different sources of earnings for the GPs, and I ran it through this GP split structure. So you can actually aggregate um, how much each partner is going to make, and at which part of the GP earning structure will they make their money. Everything is split pretty evenly among all these buckets of work, with the exception of the asset management fee, which goes entirely to the asset management bucket of work.